As we go through the first quarter of 2023, is your investment portfolio best positioned for what lies ahead in the economy and the markets? What are the key factors affecting the economy right now, and which sections of the market look attractive? Today I'm speaking with Dave Kressner, Managing Advisor of Altfest Personal Wealth Management, to get a recap of what happened in the economy and the markets in 2022, what's happening in the economy so far in 2023, and a glimpse into Altfest's 2023 market outlook. Hello everybody, and welcome to Wealth Matters for Physicians by Altfest Personal Wealth Management, the channel that provides key investing and personal financial planning insights to help physicians achieve their key life goals. Before I bring in Dave, a few words about Altfest. For nearly 40 years, Altfest Personal Wealth Management has been helping physicians holistically optimize all areas of their personal financial lives in a fully objective, no commissions manner, while as a legal fiduciary, always putting our physicians' best interests first. As I mentioned, my guest today is Dave Kressner. Dave is a chartered financial analyst, a certified financial planner, and a managing advisor at Altfest Personal Wealth Management. He has been helping and advising physician clients at Altfest for several years. So Dave, thank you very much for being with us today on Wealth Matters for Physicians.
Thanks so much for having me.
It's a pleasure. So, let's get right to it.
Sure.
To start off talking about investments, can you give us a brief recap of what happened, or the main points that happened in the economy and the markets in 2022?
Sure. 2022 really was a remarkable year. But I think in order to understand 2022, you really need to put it in the context of what happened directly before it. At the onset of the pandemic, governments around the world pumped a lot of stimulus into the economy, both fiscal and monetary, in order to essentially kind of save the economy from the downturn that it experienced directly in the wake of the pandemic. Some of the fiscal stimulus that you can think of include things like the stimulus checks that people received, the PPP program, enhanced unemployment benefits. From a monetary perspective, you can think of the Federal Reserve decreasing interest rates to very, very low levels. And these efforts that the governments did were rewarded in that it provided a huge jolt to the economy and pulled the economy out from this recession and made it the shortest recession of just 3 months on record.
Right, exactly. Well, that was a very good recap of all the forces, Dave, that were kind of having major influences on what was to happen in 2022. Can you tell us what were like the main effects or things that happened actually in 22 in the past year?
Sure. So all of that stimulus, while it was helpful in breathing life into the economy, it did have some undesirable consequences. The most notable of those was that inflation of almost everything really went through the roof.
Through the roof.
Yeah, that by the end of that inflation peaked in June or so of the year at a level of about 9%, but then finished the year at about 7%, still at a very elevated level compared to history. To give you a sense, the target inflation rate of the Federal Reserve is about 2%. And historical inflation is much less than either 9 or 7%. So the levels of inflation that we experienced last year were at a very high level compared to historical levels, as well as the comfort level of the Federal Reserve.
Excellent, excellent. So Dave, that's really very good in terms of the information about inflation in 2022. What were some of the implications that came out of such high inflation levels?
Yeah, so it's important to understand the role of the Federal Reserve and the responsibility of the Federal Reserve to understand the implications. So the Federal Reserve in the U.S. has a dual mandate where they're responsible for price stability and for employment. And as we mentioned, price stability was out the window in 2022.
Right.
But on the other side of that, the other responsibility of the Federal Reserve, employment remained extremely strong. It finished the year at about 3.5%, which is the lowest levels in about 50 years or so. So faced with very high inflation and a very strong job market, the Federal Reserve was able to act very aggressively with one of their primary tools, interest rates, and they increased interest rates quite a lot over the course of 2022. They started the year at a very low level of about 0%, and the Federal Reserve increased rates at a rate that we really haven't seen since the very high inflation of the 1980s. And by the end of the year, they ended at about 4.5%. Essentially, kind of what the Federal Reserve did was that they put the brakes on the economy. And not only did they do that, they said that they likely won't be decreasing rates for a period of time. So essentially, kind of like the expectation is that those brakes may be on for at least into the beginning of 2023 and maybe even longer.
Thank you very much. And so with all this stuff happening, inflation rising, the Federal Reserve rising rates in order to curb that inflation while sort of trying to protect, go to a soft landing, not go to too harsh increases in the unemployment level, how did stocks and bonds and investments do in 2022?
Yeah, that was really sort of the story of the year with the markets, was that the markets did not respond very positively to those higher rates. And actually, we have a slide talking about that. Perhaps we could go to that now.
Sounds good.
So interest rates, which we talked about earlier, Mike, are directly tied to bond prices. Higher interest rates mean lower bond prices. And as you can see, looking at this table, bond prices in the US were down very dramatically. Bonds on average were down about 13%, with some of the safest bonds, US Treasuries, down even more. You can see on this chart that the 10-year Treasury was down about 16%, and the 30-year Treasury, which is the longest that's issued by the US Treasury, was down a truly staggering 33%. Looking at the table directly below, you can see that stocks were definitely not spared from this misery. U.S. stocks, as represented by the S&P 500, were down about 18% on the year, and international stocks did nearly as poorly, down about 14%.
Wow, so there was a lot of damage in 2022.
Yeah, really, sort of nothing was spared. And when you think about most investor portfolios that are made up of primarily stocks and bonds, most investors experience dramatic declines in their portfolio over the course of the year.
Thank you very much. Well, Dave, that was a really good recap of what happened in 2022. Can you tell us what we've seen so far in the economy in 2023?
Sure, Mike. So as we had mentioned, while inflation may have peaked in 2022, it's still at very elevated levels entering 2023 in both developed countries like the US and emerging countries as well. There's dispersion between inflation in different countries, but on average, we see inflation between 7 and 8% globally. And the central bank in the US was not alone in terms of raising interest rates. Central banks around the world acted in unison, essentially kind of putting the brakes on the economy. So what we're starting to see is some indicators of business activity starting to decrease. And we have a slide discussing that if we'd like to go to that now.
Let's go to it.
Great, Mike. So what we're looking at now is two charts. On the left, we see a chart of the leading economic indicators, or the LEI. This chart, this data point, is a composite of a number of different pieces of data. So it includes things like the stock market, consumer confidence, jobless claims, among other items that we would expect to be forward-looking to tell us where things are going. And what we can see, looking at this, is that it's taken a dramatic turn to the downside, and this is indicative of potentially a slowing economy. And when we look at the chart on the right, we see another indicator. This one is called the Purchasing Managers Index. And this indicator is a survey that they send out to business leaders to get a sense of what their expectations are for their businesses. Answers greater than, or responses greater than 50 indicate growth, so above the line on this, running across the middle of this chart, and below the line of 50 indicate contraction. And what we see here is that the responses to many of these in many different parts of the world are less than 50, or indicating contraction.
Well, thank you very much, Dave, for being on Wealth Matters for Physicians today. You've given our physician audience a great deal of useful information to think about.
Great. Well, thanks so much for having me, Mike.
Our pleasure. If you'd like to discuss the information explained in today's video, receive a complimentary analysis of your investment portfolio or retirement readiness, or discuss any of your other personal financial planning areas with an Altfest professional at no obligation, please contact my colleague Jesse Freeling at 212-796-8732, or by emailing Jesse at his email address, which is also in the description of today's video below. If you like today's video, please click the subscribe button below and hit the bell icon to receive notifications each time we send or release a new one. If you think that a fellow physician would find this video interesting or useful, please share it with him or her to help them also get their finances optimized. Lastly, as always, if you have any topics you'd like us to cover, like or dislike certain things that we're doing, or have any other feedback, we'd love to hear from you. So please share your comments in the comments section below. Well, that's all for now, physicians. Thank you very much for watching today's video, and I look forward to being with you in our next one. Until then, be well, remember to keep on optimizing your finances, and let us help you if you'd like.